This recording is for informational purposes only. It does not constitute legal, financial, or investment advice.
The views expressed are those of the hosts and guests and do not represent any organization, including Bank of North Dakota. Please seek professional guidance before making financial decisions.
Welcome to 701 Chain. I'm Michael Lehn, joined by my co-host Devon Smith. Today we're excited to sit down with Derek Binstock, Chief Investment Officer at Bravera Wealth. Let's jump right in. Hey Derek, how's it going?
Great, Michael. How are you doing?
Not too bad, not too bad. I appreciate you making the 5-minute commute down the street.
That was a long one, but I managed. I managed.
Good. So being the Chief Investment Officer at Bravera Wealth, what are your biggest challenges right now, and how is AI playing a role?
Sure. Our department is portfolio management, and so we have to be on the ball and understand what's going on, not only in the market, but in the economy, in the political world, geopolitics, disruptions, things like that. There's always something to be concerned about in our industry. It's just knowing how the market's going to react and how to kind of skate around it and where things are going to go. And so just being present and really listening for things that come about is our primary goal. As far as what we're concerned of, you can be concerned about as much as you want. It depends on what kind of personality you have. I think for us, it's just looking at, we know the market typically sees through a lot of things. And so we know that the market's also very, very efficient. And so the market's going to do what the market's going to do based on my bias or my thought of projection of what's going to happen.
Absolutely.
So we just have to be aligned, and we have to make sure that we're not making a lot of knee-jerk reactions. As far as how we use AI, first off, we don't use it to replace judgment, but we use it to make things more efficient.
Just like another tool, right?
Another tool, you bet. And it has helped quite a bit. Bravera has been very forward on the capturing AI. I'm on the committee, an AI committee, and I was surprised. And I was about a year ago we started this, and I was very, very surprised of how far we were in the process. I thought it's going to take a long time and everything else. Well, we actually have we use Copilot throughout our whole company. We are very aware of, protecting personal information and things like that. And it's just the education on how to use it primarily. And, Copilot's a great name for it because it should be a Copilot, not autopilot. Right. And so I think it's a great tool for me, especially, to utilize to get the data that I'm looking for versus a Google search or waiting for an analyst or someone to come out and give a presentation or post something on X. You can actually try to scour the whole market with it, and that really helps out. We do have to dive into the information that we receive and break it apart and find out if something's off. I use it a lot to tell me what happened and recap a month. And sometimes when I look into it, I find out that it's recapping April of 2025, and I didn't give it the right prompt, of 2026. Right. And so you have to go back and be like, oh, hey, let's start over. And so it has been a great tool. We use it in lockstep with our old traditional practices of listening and reading a lot and using multiple sources, listening to the extremes on both ends and figuring out what's real somewhere in the middle. There's a lot of biases out there.
I think with AI too, there's so many and I'm not trying to discredit them, but there's a lot of fly by night. Hey, I'll be your financial advisor, AI. But the point that we make a lot is you can't hold an AI accountable, right? So autonomous car runs over a pedestrian, you can't charge the car, right? So if you want to speak to just a little bit of that, like, A, yes, you're the human in the loop, but B, you're also the trusted human in the loop. Like that's what the institution provides to both businesses and consumers.
Yeah. My favorite piece is, being held accountable. And we have to be aware that everything that we talk to clients about or present to a committee or a board, we have to be ready for the question of, is that true, or why is that happening, or how, and where did you get that information? And we have to have resources where we can go that are trustable and accountable, that we can go back to and say, here's the source. And so for us, it's it seems like AI should replace a lot of the research that we do, but it actually just brings a lot more data into our space, and we spend a lot more time just making sure that it all matches up and it's real and true, versus something that there's a hiccup, or what do they call it, a hallucination. Yeah.
Similar to tokenization for us bankers, I know there's been a lot of discussion for tokenization within the wealth management area. Can you touch on that? And because we're hearing that some of the large exchanges are looking at bringing tokenization to the equity markets.
Yeah, that's big. We have it's a lot of talk right now, but every day it's getting closer and closer. And I think that it'll eventually happen for sure. Tokenization scares a lot of people because they think it's fake, it's not tangible. How do we trust it? And I think that we forget that there's a lot of tokenization in the world today already, right? Everything's digitized, and we trust that it's actually there, even though we can't touch it or see it. But it's all about the institution that you trust. It's the promise that's made that they're going to adhere to whatever's owed to you. That makes things a lot more calming and understandable. The tokenization of equities, let's start there, and securities, that is going to be interesting. It's going to allow people to trade around the clock, because we're hearing the 24/7 trading. If we look at how that's affected right now, the stock market's open from 8:30 Central Time until 3 o'clock Central Time. That's the trading hours that Bravera can trade through. We do all of our own record keeping, and so we have a cutoff, a hard cutoff at like 2:30 in the afternoon, so we can get everything sent and submitted to our custodian, so everything's processed and we capture those trades. So institutions like us and other financial institutions are limited to that trade, the stock market exchange open and close. Now, as a retail investor on an app like Robinhood or Schwab, you can trade outside those hours for a specific amount of time, pre-trade hours and post-trade hours. What's difficult about that is the majority of trading happens within that time frame that stock exchange is open. When you get outside of that, the volume isn't there. So there's not enough buyers and sellers on all the assets. I mean, some of the larger ones trade fairly high volume, but there's a lot of rebalancing that goes on after that. And if there's some things that have low volume of trading in a regular day, it's going to be extremely low outside of the normal trading hours. How that affects somebody is we're used to seeing a bid and ask or a price that shows up on your app, and that's pretty much what you lock in within a matter of cents or very close enough, right? After hour trading, you're not going to have the volume there. So if you see the price that shows for something to be traded, say it's $100 for a security, and you go to sell it and you just sell at market, you might not have somebody available to buy it at 100 that finds it attractive at 100, and the next available person might find it attractive at 95. So here you think you're getting your full price of what it showed on the ticker, but in reality, you might get 5% lower, and that could really screw things up if you depend on that full par, right? So now we take it a step further and go 24/7. Who's up at 3 a.m. except maybe my daughters, and doing trades though. And so the volume is even more limited, and you're out there guessing, and it could work to your advantage, but it could also work to your detriment. So I have to understand how that happens. Now I know that globally trading goes on 24/7. You know, the Asia market opens up at like 8:00 p.m. We start watching things move, but nothing happens over here. But price affects that, and how, trends, it kind of moves in the same direction. So if the Asia market opens and things are just, the whole breadth of the market's lifted, we know that we're probably going to open a little bit better over here because of whatever news is driving that, or whatever thing in the market's driving that.
Would it be safe to say that adopting or actually enabling tokenization within the equity markets would increase liquidity over time?
Over time, yeah. The reason that I think it's bound to happen, and it's very, very encouraged, is because you have a lot of different generations that are trading, right? You have generation of the baby boomers who are so super old school traditional, right? That they're skeptical of this. But then you've got I have 3 daughters, and I know one thing about them. They don't like stuff. They like stuff because they buy. I see their credit card. I see my credit card. I see their bank accounts. I see what they spend money on. But they like things that are going to be easy or disposable, or that they don't have to be responsible for in the future. It's a lot of services that they spend their money on, not things. And they don't want to be responsible for cleaning it, maintaining it, making sure that transporting it if they move, or anything like that. So this new generation doesn't like things. Tokenization gives them access to securities and different stuff. During the big tokenization of NFTs, and real estate was going to be tokenized, they could have ownership but not have to be responsible and have it at their house, or be responsible for caring for it or maintaining it. Tokenization just makes sense for them because everything that a kid needs nowadays is on their phone. Entertainment, transportation, food, Grubhub, right? Friends, communication, almost everything. And that advancement's making tokenization become a real reality. And I think that's part of it. The other part that anybody who fears tokenization or doesn't understand, it's because they don't understand it. Because if we think a lot of the normal processes in the financial system, we still kind of have that mindset that when you take $1 to the bank and deposit it, that dollar, the banker, the teller, takes it and puts it in a little box that says your name on it, and it's protected and right there for when you need it. And when you come to the bank next time and take that $1 out, it's going to be that same dollar. So if you put a dot of nail polish on it, it's going to have that same dot on it, and you're going to get that back. So in the mind of most people, that gives them comfort when we know that that's not how it works. It's a giant ledger, and it's been that way for quite a long time, whether we want to admit it or not. We talked a little bit about the stagecoach bringing money from one place to the next.
100%.
In our minds, that's the process that makes sense. We don't understand the tokenization yet, and so it's causes a little angst.
Yeah, that's a bit of the argument too with digital assets. I mean, we've been dealing with digital dollars for 30 years now. We're calling it something different. Not to pivot, but along the same lines of that 24/7 access. I mean, that is the way that cryptocurrencies work. Massive things like global conflict and things like that, those affect those markets pretty quickly, whether it's Iran or anything else going on in Venezuela. So kind of part one is, perspective on that 24/7 market with digital assets like cryptocurrencies. And then part two is you have these institutions like BlackRock and Morgan Stanley that are building these ETFs around digital assets, and they've been fairly successful so far.
Yeah, the cryptocurrency and the Bitcoin market being 24/7 is a reality, and unfortunately, human beings need to turn off and sleep every once in a while. And if there's a giant move overnight and we're sleeping, we can't have optimization with that
Right.
and capture that, right? And so whoever's on in the certain times, we all have to sleep. Everybody's going to miss out on something, a downturn or upswing. Um, it's another reason why I think it does make sense for tokenization of assets, but there's got to be some kind of control in there on regulation. I think the big institutions still need to adhere by some parameters,
Right.
maybe.
Yeah.
But even if the retail person can have access all the time, there's a lot of people that work all night, and that's the only time they can trade if they want to be a trader while they're working and quietly. I'm doing my job.
Right.
But I think I just I really think that the tokenization part, the 24/7 thing, it's got a place, and it's probably going to be reality before we know it. Now, to get into the ETFs of Bitcoin, and other cryptocurrencies, BlackRock's super success on this, I think that gave everybody, because it's through BlackRock or Morgan Stanley or another financial company that's creating this, or somebody trusted,
Right.
where there's got a lot of regulation and a lot of protocol and process. It gives people a little bit more comfort to run it through there versus to run it through something that's not proven yet.
Right.
And when I remember in 2017, when this was all talked about as about an ETF, how many people were just kiboshing this and saying it's never going to happen, it can't happen. And here we are today, and it's one of the most successful ETFs out there. There's a lot of pent up demand for it, true, as well.
For sure. And right, they're not small players.
No.
Correct.
And they're heavily regulated, and it's kind of that we use the phrase that like bankers are kind of the adults in the room, and so that community that's associated with Bitcoin having the backing of an institution like a Morgan Stanley or a BlackRock or any other large institution, it really just brings in that backing that makes it legitimate that we would have scoffed at in 2017, like you said.
It's truly making Bitcoin institutionalized.
Yeah, no, absolutely.
No, I agree with that. And it maybe makes people feel a little bit more comfortable and allowed to hold Bitcoin,
Right.
when before it was like, oh, that's risky.
Yeah.
But then owning a Bitcoin ETF as part of your portfolio, it's like, oh, that's smart, and so it's being adapted in our society.
Why are so many equities going to an ETF?
A lot of reasons. Just to let you know, we made a big change at Bravera in our department. We went from the traditional mutual funds in a lot of our models over to ETFs. And it was a thoughtful process. It took a lot of time. We actually ran the model in the background for almost a year to see how it would react to upside, downside, market turbulence, things like that, see how it performed.
Kind of like an internal beta test or like an internal sandbox?
Correct, very much, without investing $1 of a client's money into it.
Awesome.
After we saw that and we got that and we brought it to our committee, we have a process. We bring it to the committee. We bring it to trust committee and investment committee. And we got the green light on it and it made sense, but we had to show a lot of data. And we created that. ETFs, we have found that they're more efficient. They're less cost. Our traditional mutual fund model is ran by a manager who charges a fee ETFs are a wrapper, like a bouquet of flowers of stocks or whatever security is in there. And you get the tax advantages of ETFs as well, because in a mutual fund, what that does, it's a giant block, a bucket of funds, of securities. And if there's a lot of people that want to take their money out of there, they have to go to that fund manager, say, I like my $1 million, please. So the fund manager, if the $1 million is setting in liquid form, he can get that to them. But if it's not, if it's tied up in securities, they got to sell off securities. And they're going to sell off securities. Sometimes they might be forced to sell off securities that they've held that have appreciated so much. And there's a tax implication there. And that gets passed down to the client as a pass-through. ETFs, it's a wrapper. It's traded and unwrapped and traded back and forth between a person to a person, to where they're not selling that to create a tax event. And it's very, very tax advantageous to the client. And so there are a lot of other reasons too that ETFs are a lot more transparent. Mutual funds, sometimes you get a report quarterly or monthly, if they're good, that show their holdings, show you what they've done in the last term. ETFs, I can go into a lot of ETFs and I can go on the website and I can see what they did that day in transactions, what they bought, what they sold, or they didn't do anything. So it gives me more knowledge to explain to clients as well.
Oh, that makes sense.
On the transparency.
Makes sense.
I think just with your role at Bravera, there's so much information that's out there, and I'm sure it's difficult to kind of parse through what's real, what's fake, what's overly optimistic, and what's overly pessimistic. So how do you kind of sift through that noise in order to be a decision maker, the adult at the table?
Sure. It's easy for me personally because I have 3 daughters and a wife. So my opinion on anything doesn't matter at our house, first off. So I don't have any opinion or anything. I listen and I sort through the biases. Listen to both sides. My morning starts off by listening to one media outlet for about a half hour, an hour. That's very strong sided. And then my next hour in the morning before I even go to work is listening to the other side and really picking apart and looking for the pattern of things that work together. And that's kind of the truth in the middle. We do have to sort through everything. We do have to listen outside of the banker's hours of 8 to 5, right? We do have to be on at all times. Our last administration, we didn't hear anything. It was very opaque. This administration is very, very transparent, almost to a point of like, please don't tell us everything all the time. So there's a lot more information, and the reaction, because of a lot of before and after our market ability to capture that in the markets, we do see a lot more volatility that way. We get through a week and Friday night, the Strait of Hormuz closes or whatever. And it's like, oh man, here we go. Long weekend.
Absolutely.
And so, then it's not turn off the TV and wait till they tell us something on Monday. It's listening to all the data throughout the weekend and going to those respected sources to find out what they're hearing, what they're saying, rather than just focusing on the headlines.
Yeah.
You look at movement of funds or movement of money for your clients. Obviously, with essentially moving those funds to you to invest, or taking some investments and moving those out to, for other types of investments, or just to essentially pay some bills. Are you seeing some of those bank-to-bank transfers still, I guess originating through wires and ACHs?
Of course. That's the way it's been since the 70s.
Yeah.
So,
and do you envision that evolve? I guess, would you expect that to evolve over time?
Like everything, it has to, right? And so, I've listened to a lot of what Bank of North Dakota has done to get in front of this for the benefit of all the banks, right? I think that's a huge piece that a lot of states, all states, I'll say, don't have that advantage. I've been to the road shows. I've listened to the stablecoin concept and the new rails that are being created. And I get it. Anything new outside of the norm creates a little bit of unsure and instability and questionability about regulation and safety. What Bank of North Dakota is doing for all of the regional banks in the state is a huge asset. Rather than us wait to hear what some of the big boys are doing, like JP Morgan and BlackRock and things like that, you're doing the research for us in order to find the best way for it to happen.
Yeah, and that's one of the things that we've heard just in the market is that like customers aren't necessarily asking their financial institution for digital asset solutions. They're just going to go seek it out where they can find it. So if we can get in front of it as, an industry and be able to provide that to them, because they already kind of trust us, right? Everywhere has to have direct deposit, right? So that paycheck hits and maybe you do want to do some sort of diversification with digital assets. Being able to provide that infrastructure is kind of the end goal here. I think at right about time. So thank you to Derek again for visiting with us today. Thanks for listening to 701 Chain. Michael and I appreciate you joining us, and we hope you'll tune in next time for more conversations shaping North Dakota's financial future.